Welcome everyone, welcome people of the internet, welcome people of YouTube. Basically what we're doing today is we are going to compare SCHD versus SCHG, two Charles Schwab ETFs. Now, what are these different ETFs? Well, the SCHD ETF is a Charles Schwab US Dividend Equity ETF, and it's down 15.52% so far year to date. Now, SCHG is the Schwab US Large Cap Growth ETF, and it's down 29.59% so far year to date. So basically, SCHG is down way more than SCHD. So we're going to compare these two because they're very different ETFs. One's more risky and more towards growth-oriented investing. The other one is more towards dividend investing. However, they both performed decently in the past. So let's see how they look comparatively speaking. So we're going to start in the place that I know everyone always wants to start, and that is, what is the net expense ratio? So the net expense ratio on the left side here of SCHD is 0.06%. The net expense ratio of SCHG is 0.04%. This is very interesting. I have no idea why SCHD is more than SCHG. I mean, I would have thought they would be the same expense ratio, but apparently they're not. So you learn something every single day when you do this stuff. So the yields, okay. The dividend investors out there, they love SCHD, and for good reason. It's done a great job, great yield, 3.42% for the SEC 30-day yield. So that's when we're looking at a shorter time period, because what's going on in the market, I think it's good to look at these shorter time period yields. And then if you take a look at the 30-day for SCHG, it's only 0.44. So very different what you're going for here. SCHD, you're going for yield, and you also are probably maybe going for capital appreciation, because SCHD, as you'll see, has done a good job with capital appreciation, even though it's got great yield. And then SCHG, you're definitely not going for yield. You don't care about 0.44%. That's like you're throwing that out. You're basically saying, I want to get some growth. In terms of the portfolios, so we have SCHD, which has 104 different holdings inside of it. And then we have SCHG with 228 inside of that. So 228, obviously, it's a bigger portfolio, SCHG, than SCHD. The size of the companies inside the portfolios, the average is actually also pretty different. So the median market cap is 74 for SCHD. So 74 billion is the median size company, and then the median size company in SCHG is 354 billion. So much larger in SCHG. SCHG, you have like the normal growth companies that you would think you would have. Apple, Amazon, Microsoft, Tesla, Google, United Healthcare, Meta, Nvidia. You almost would think this is a S&P 500 ETF, like a VOO, right? It's not, but the top 10 holdings are probably very similar. SCHD has a very more probably unique type of portfolio, more, of course, growth dividend oriented. So then we have Merck, we have Pepsi, we have Texas Instruments, IBM, Pfizer, Verizon, Coca-Cola, Amgen, Broadcom, Cisco. So you do have some semiconductor companies in there. So of course, that's also interesting to me. Semis being more kind of, growth type stocks, a bit hyped lately, but apparently they're good enough to make it into the dividend paying portfolio here. And I'm not saying that the semis are bad. I do own a couple semiconductor ETFs, but I'm just saying that they were kind of hyped up recently, as you could see by their decline in stock price recently. So in terms of the sector weightings, so we're going to have a big probably difference in sector weightings. So financials, weirdly enough, maybe it's not weird. SCHD has quite a bit in financials. It's got quite a bit in information technology, actually, which is interesting. Of course, SCHG has the most in information technology because that's the biggest growth type sector you can think of. But healthcare is also in here, the second largest of the sectors. Then we have consumer discretionary. So I believe Tesla, for example, would fall into consumer discretionary. Communication services is also in there. But just going to have the Googles, right? So Google has two share classes, but Google would be in the communications sector. And then in terms of market cap, like we were talking about before, so giant market caps, SCHD 32%, SCHG 66. So SCHG, you're going to get a bigger, larger type of company as the average company in there. And then large, of course, SCHD 40, and then SCHG 20. So the top two, the giant and large, is over 85% of the portfolio of SCHG, and then only 12 in medium. And of course, SCHD has 23. So more in the large/medium blend probably for SCHD. In terms of portfolio returns, how have these done? So here we're looking at the returns of the portfolios. These are assuming we're reinvesting the dividends. Of course, we want it to be more apples to apples. If you took all your distribution out of SCHD, then it wouldn't be apples to apples because there's so much more distribution for SCHD. So anyway, we have over here, we're looking at around November time period 2011 till today. How's this look? Well, you have SCHG as a 330% return. SCHD is a 272% return. Now, what I wanted to show you here is what's interesting about SCHD, and I wanted to overlay this with SPY, so the S&P 500, just so you could see this red one. So SCHG kind of has underperformed by a little bit, SPY, but I want to show you here when you kind of look back a little bit in a different context here. So if you go back to December of 2016, you can see that actually SCHD outperformed VOO from that time period, January of 2017 until January of 2022. So you might say I'm cherry picking here, but basically the idea is that SCHD with a great dividend yield is still has time periods when it can hold up with the general market. Now, of course, we have SCHG which did better than that, but I think it's interesting that SCHD has time periods when it can keep up with the general S&P 500 index. Okay, let's take a look at triple Q to see how that looks versus SCHG. So if we go back again, a longer time period here, we're looking at November of 2011. So how does this look? Well, triple Q has outperformed both SCHD and SPY and SCHG, of course. So basically what's happening is triple Q has had a better return than all of these, but of course, probably more volatile. And so let's take a look at that. So here we're looking at a backtest going back to December of 2011. And what we're looking at here is what if you invested $100,000, what would it look like here? So if you had invested $100,000 back in 2011 in December, this is what these numbers look like. SCHD, SCHG, triple Q. So SCHD grows to 379,000, SCHG 465,000, triple Q 592,000, and the compound annual growth rates are here. Now, what I wanted to go over is standard deviations, so how volatile these stocks are, or these ETFs are. So SCHD is the less volatile of these, 13.23%. Then you have SCHG, 15.76, and then you have triple Q with 16.91. So 16.91% is more volatile and the most volatile of these, but you do get the return, 18.15% return, which did better than these all. So let's take a look at the yield. And so obviously, if you care about income, you're going to have SCHD looking pretty good here. If income is the most important to you and capital appreciation is not necessarily the most important. But here, SCHD, the blue basically bar is how much yield is coming off of this. And obviously, it's the most out of all of them every single year. The red one is SCHG, and then triple Q is the kind of yellow, orange looking one, I guess that's orange. And then, so basically I would say that some years triple Q has more yield, some years SCHG has more yield. But again, you probably don't care about yield if you're investing in those type of ETFs. You care about capital appreciation. All right, now let's do something interesting. What if we combine these two portfolios? How does the back test look? So let's take portfolio 1 is still SCHD, portfolio 2 is still SCHG, but portfolio 3 is if you combine SCHD and SCHG together and you have 50% in each of them. So what's that look like? So the final balance is 425,000, so a little bit less than portfolio 2, which is SCHG, but more than SCHD. You actually have a little bit of a riskier portfolio, 13.74% versus 13.23%, but you have a lot more money than you did if you just went with SCHD. So for me, I am very much more comfortable having a higher capital appreciation with a little bit more risk and barely any more risk. It does, of course, matter if you're more of a dividend type of investor, if you want yield or not, because if you do want yield, well, portfolio 3, which is the mixed portfolio, does have a little bit less yield than the SCHD on its own, of course, but still, you're getting decent yield, right? Here we can actually see the numbers annually, so that will help us. So we have the yield of portfolio 3 of the blended portfolio. We have 2.36%, and the income was $2,361. Over here, we have 3.13%, income of $3,127. So of course, a little bit more yield in SCHD than SCH, or the combination of two ETFs. Let's take a look at 2021. You can see the yield of 3.55% for SCHD that gave an income of $11,384. The yield for the blended portfolio is actually 2.05. So actually the yield actually was quite a bit lower in 2021, and the yield was $8,000. But again, you have $508,000 in the blended portfolio and only $416,000. So you have $75,000 more inside the portfolio, and the yield, of course, is a bit lower, but you have more money. So anyway, that's all I have. 2 different ETFs for 2 different reasons for 2 different portfolios, or you could own them together in a portfolio and they can also help each other out maybe. So anyway, that's all I have. Thanks so much for watching. If you like this, please hit that like button, subscribe to see videos like this. And I got another video coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.